Hello, 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 hello. Welcome to our next chapter, that is your partnership firm and LLP taxation. So this is part of our DT 50-page notes. So let's start. So how do you tax first of all your partnership firm or your LLP? LLP is your limited liability partnership. So first of all, for them, tax rate is 30% and surcharge will be 12% only and only if their NTI is greater than 1 crore. So these slab rates we have also done in our first chapter, that is your basic concepts in tax rate. Any special income tax rate will be same as individual. So whichever income has any special tax rate, it will be same for partnership and LLP as well. Now, next point that you have to remember is whatever interest and whatever remuneration that the partners receive, that is the partners of the firm. So, whatever interest and remuneration that the partners receive, that will be taxable under PGBP. Even though it is called remuneration, do not tax it under salary, it will be taxed under PGBP, that is your profit and gains from business and profession. Next is your interest and remuneration deduction will be allowed. Deduction to whom? Deduction to the firm or the LLP. That is whatever interest or whatever remuneration they are paying to the partners, that will be allowed only and only if the remuneration, first of all, it should be paid to a working partner. So this remuneration you are paying to a working partner, only then will the firm be allowed as a deduction. Next is remuneration and interest is authorized by partnership deed. Remember, all of these points have to be satisfied. It is not a or condition, it is an and condition. So all 4 points have to be satisfied. So the remuneration and interest is authorized by partnership deed. That is, that there should be a partnership deed, and the partnership deed should specify ki, boss, this is the remuneration, this is the interest that is allowed. So this is your second point. Your third point is firm has partnership deed specifying profit sharing ratio. PSR stands for profit sharing ratio. That is the partnership deed should specify that, boss, this partner has this much profit, this partner has this much profit, this partner has this much profit. So it should specify the profit sharing ratio. And your last point is partnership deed must be furnished with the first return. That is, whatever, whenever you file the first return of income tax, that is when this partnership deed should also be furnished along with the return of income. Okay. And next, any partnership deed cannot retrospectively allow interest or remuneration. What does this mean? Because a lot of time in the questions they'll give you that, was there was no partnership deed earlier, we have been paying remuneration, so what does the firm do? The firm enters into a partnership deed today and allows payment of remuneration and interest retrospectively, that is from a earlier date. So this means that this is not allowed. You cannot do this. Only and only from the date you enter into the partnership deed, only from that date onwards, you will get your remuneration and interest deduction. So this note is very important. You have to remember it while solving questions. Next is interest on loan and capital will be lower of whatever interest you are paying, that will be lower of the actual interest amount that is actually being paid, or the deed interest, that is the interest that has been specified in the deed. Whatever interest has been specified in the deed, or how much in amount you have actually paid, or maximum they have capped it at 12%. That means in no circumstance will the firm be allowed as a deduction of interest of more than 12% of the capital amount. So it is actual interest, deed interest for 12%, whichever is lower among all three of them. Now next is the losses of firm in case of retirement or death of partner or firm cannot be carried forward or set off the share of loss of such partner. For example, the firm had a loss of 1 lakh being carried forward. Okay. Now suppose out of two partners, one partner passed away. Now since this one partner passed away and assume there is a equal profit sharing ratio, so now this partner's share of loss, that is your 50,000, water provision says that the firm will not be allowed to carry forward or set off this loss of such partner, because this partner has already passed away. So this 50,000 will not be allowed to be set off. Next, in case of change in constitution of firm, you will have to require one return only. What is change in constitution of firm? That is, for example, any change in profit sharing ratio. Or for example, earlier there were partners A, B, C, and now A has left. So only partners B and C are left. That means there is a change in constitution. Or for example, there were earlier partners A, B, and now partners A, B, and D, that is D has joined. So this will be called as this will be called as constitution of firm. So in case of change in constitution of firm, you are required to file one return only. That means you do not have to file two returns. That boss, till this date we were two people and after this date we are three people, so we are filing two separate returns. No, you only need to file one return. Okay, but in case of succession of firm, you are required to file two returns. Now, what is succession? For example, earlier there were partners A, B, and C, and now there are partners D, E, and F. That is completely different partners, correct? So first we had three partners A, B, C. Now there are partners D, E, F. It is completely different people. That means the firm has been succeeded by partners D, E, and F. So in case of succession of firm, you are required to file two returns. One during the time period of ABC, another during the time period of DEF. Liability of partners. For any tax, penalty, or other sum of a particular previous year. That is, for example, if there are any outstanding, any dues that come in knowledge right now about any tax, penalty, or any other sum, every partner who was a partner at the time of the previous year will be liable. For example, we are currently in the year 2023 when I'm recording this lecture. For example, a tax litigation comes up and now that is pertaining to the year 2012. Suppose that is pertaining to the year previous year 2012. So now who will be liable to pay that tax liability? All the partners who were the partners and during the previous year of 2012, they will be liable to pay the tax amount. Okay. Now next, in case of liquidation, when tax due cannot be recovered, in case of liquidation, that means when we are closing down our firm, when we are shutting down our firm. So in case of liquidation, when the tax due cannot be recovered, every partner who was a partner at any time of the previous year shall be made liable to pay such tax. Okay. Now next is another topic of conversion of company into LLP. So whenever a private company or an unlisted company is converted to LLP, now this is a situation where a company, that is a private company or an unlisted public company, has been converted to an LLP. In such a case, what happens? So if the transfer of assets will not be taxable, transfer of assets will not be taxable because these are two separate entities. That is, my company and an LLP are both separate entities. So what they're saying, that my transfer of assets will not be taxable only and only if my sale, turnover, gross receipts of the company, that is the sale, turnover, gross receipts, whatever you call, if that is up to 60 lakhs, that is equal to or 60 lakhs, you have to remember in all three previous years, my turnover has to be up to 60 lakhs. That means equal to or less than, all of them are allowed. Next condition, the shareholders of the company shall become partners of LLP in same proportion. Whatever the holding of the people in the company was, in the same proportion they should have in the LLP as well. They should, in the same proportion should they become partners. Next, no consideration other than share in profit and capital contribution in LLP arises to shareholders, the shareholders that are now being converted to partners. So what are they saying? That there should be no consideration other than share in profit and capital contribution. In the LLP, they should only receive your share in profit and capital contribution. The shareholders which are originally shareholders of the company, now partners of the firm. Next, your old shareholders to receive at least 50% of the profit of LLP for the next 5 years. So the company which has now been converted to partnership, these old shareholders which are now partners, they must receive at least 50%. That means equal to or less than 50% is not allowed. It has to be at least 50%, which means 50% or more than 50% is allowed. Got it? So either 50 or anything more than 50, that is what profit they should be having. Next, book value of assets of company should be less than or equal to 5 crore in all three previous years. So what do you have to remember? One limit is with regards to 60 lakhs of turnover. Next limit is 50% of profits. Another limit is your book value of assets. Your assets should be up to 5 crore. equal to or less than 5 crore in all of the 3 previous years. And your last is all assets and liabilities of the company shall be taken by the LLP. So the LLP cannot choose that, boss, I want only these assets or I do not want these liabilities. You have to take all assets and liabilities. Got it? So all assets and liabilities must be taken. Your previous shareholders must have at least 50% of the profit sharing in the firm or LLP. Or your assets should be up to 5 crore. It should be up to 5 crore, not more than 5 crore in all 3 previous years. So you have to remember this is also all, this is also all 3 previous years. Okay. Now your LLP will be allowed to carry forward and set off business loss and unabsorbed depreciation of the company. For example, this private company or the unlisted public company, if they already had some losses that were being carried forwarded. So the question arises, will my LLP be allowed to carry forward and set off or not? So answer is yes, the LLP will be allowed to carry forward and set off business loss and unabsorbed depreciation of the company. And next is LLP will not be allowed to carry forward any MAT credit of the company. Okay, so MAT is your minimum alternate tax. So minimum alternate tax, if there is any credit of minimum alternate tax, that you will not be allowed to set off, but you will be allowed to set off what? Carry forward losses. Got it? And your last point of this chapter is WDV of assets for LLP is equal to WDV of assets for company on date of conversion. That is, for depreciation purpose, the assets will be valued at the same amount, even though the transaction must have occurred at a different amount for the purpose of depreciation for income tax. WDV of company will be WDV of LLP. So, for example, they'll give you a situation, for example, that the WDV in the books was rupees 100, but during the merger they transferred this asset for 120. For your income tax purpose, this 120 is useless. Your For the purpose of WDV, it will still be 100 only. Got it? And next is depreciation to be allocated on number of days of proportion. So what you do, you calculate depreciation as if this conversion never happened. You calculate the total depreciation and then we will bifurcate this depreciation based on how many days which person has used. For example, the company was converted on 1st of May. So 1st of May, that means full April it was a company. From 1st April till 30th April, full April it was a company. Now April has 30 days. So whatever depreciation we calculate, we will be bifurcating that into 30 is to 335. That is total days. We have 365 days. So out of 365, 30 days it was with the company and 335 days it was with the firm or partnership LLP. So we will be bifurcating depreciation. We will be allocating depreciation in this ratio. And with this, we are done with the chapter, and our next one will be AOP and BOI. Like the video, and I'll see you later.